On the morning of April 18, 1906, at 12 minutes past 5, the largest earthquake in California's recorded history struck San Francisco. The shaking lasted for approximately 45 seconds. In that time, the city's water mains ruptured, its gas lines broke open, and the fires that would ultimately prove more destructive than the earthquake itself began to spread across an urban landscape whose wooden buildings were, in the windswept April air, almost perfectly designed to burn. By the time the fires were finally controlled 3 days later, approximately 3,000 people were dead, 28,000 buildings had been destroyed, and a city of 400,000 had been reduced in its commercial and residential core to ash and rubble. Most of San Francisco's banks responded to the earthquake and the fires in the way that institutions respond to catastrophe when their primary concern is the preservation of their own assets. They closed their doors. They retrieved what they could from their vaults. They retreated. The formal announcement from the San Francisco Clearinghouse Association was that all banks would remain closed until the vaults could be inspected and declared safe, a process that was expected to take at least 10 days, possibly considerably longer. Amadeo Giannini did something different. On the day after the earthquake, while the fires were still burning, and while the city's established banking institutions were locked and silent, Giannini loaded the deposits of his bank onto a produce wagon, buried them under a layer of vegetables, and drove them through the burning streets to the waterfront at North Beach. The deposits consisted of $80,000 in gold coin and securities, all of it belonging to the Italian immigrant community of North Beach that his bank had been founded to serve. He transported it to his home in San Mateo for safekeeping. Within days, while the established banks of San Francisco remained closed, Giannini had set up a temporary office on the Washington Street wharf. A plank across 2 barrels served as his desk, and was making loans to the people of San Francisco to help them rebuild their homes and their businesses. He required no collateral. He required no formal application. He looked at the hands of the people who came to him, the calloused hands of working men and women who had worked hard all their lives, and he lent them money on the basis of that observation, on the basis of their character and their evident willingness to work. This moment, the plank across 2 barrels on the San Francisco waterfront, with the ruins of the city behind it and the ash still in the air, is the most condensed expression of what Amadeo Giannini was and what he built. A banker who believed that banking was not a privilege reserved for the wealthy, not a service provided to those who already had assets adequate to secure a loan, but a tool available to everyone, to the Italian immigrant fisherman, to the small farmer in the Central Valley, to the working family that needed a mortgage to buy their first home. A banker who, in the moment of maximum crisis, went toward the people rather than away from them. From that plank across 2 barrels, Giannini built Bank of America, the largest bank in the world for most of the mid-20th century, the institution that invented branch banking, created the first modern consumer credit card, and transformed the relationship between ordinary Americans and the financial system in ways that are so fundamental to how we live today that they are effectively invisible. This is his story. 1870. The state of California is 20 years old, having been admitted to the Union in 1850 following the gold rush that had transformed it from a Mexican territory into the most dynamic and fastest-growing region in the United States. The gold rush was over. The easy place of gold had been exhausted by the mid-1850s, but the infrastructure it had created, the population it had attracted, and the commercial energy it had generated had given California a foundation for continued growth that was making it one of the most economically significant states in the country. San Jose in 1870 was a small agricultural town at the southern end of San Francisco Bay, a community of farmers, merchants and laborers serving the agricultural economy of the Santa Clara Valley. It was, in most respects, an unremarkable place. What made it significant for the history of American banking was the arrival in 1869 of a young Italian couple, Luigi Giannini and Virginia de Martini, who had emigrated from the Ligurian village of Favel di Malvaro and who had come to California in search of the opportunity that the New World was said to offer. Luigi and Virginia settled in San Jose, where Luigi worked as a farmer and innkeeper. They had 3 children, the middle one of whom, born on May 6, 1870, was named Amadeo Giannini. Amadeo's childhood was shaped by a specific tragedy. When he was 7 years old, his father was shot and killed by a laborer in a dispute over wages. The murder was witnessed by the young Amadeo, and the experience marked him in ways that he would reflect on throughout his life, not by making him fearful or bitter, but by making him intensely aware of the vulnerability of ordinary working people and the precariousness of the economic conditions under which most families lived. His mother Virginia subsequently married Lorenzo Scatena, a produce merchant who had built a successful business in San Francisco, and the family moved to the city. Young Amadeo went to work in his stepfather's produce business as a teenager, proving himself a natural salesman and a quick learner of the commercial dynamics of the wholesale produce trade. He was walking the docks of San Francisco at 3 in the morning, buying directly from farmers and fishermen, before he was old enough to vote. By the time he was 19, he was a full partner in L. Scatena and Company, and by the time he was 31, he had built the business into one of the most successful wholesale produce operations in Northern California. In 1901, Giannini retired from the produce business. He was 31 years old, financially comfortable, and had no intention of spending the rest of his life in wholesale produce. His stepfather was doing well, and Giannini had become concerned that his increasing share of the business's profits was excessive, that he was accumulating more money than was fair or necessary. He sold his shares back to his partners and stepfather at what he believed was fair value, and he began to think about what he wanted to do next. What happened next was not a planned career transition. It was an accidental encounter with a specific gap in the American financial system that would define Giannini's life work. His father-in-law, Joseph Cuneo, died and left Giannini as one of the executors of his estate. Cuneo had been a director of the Columbus Savings and Loan Society, a small institution serving the Italian immigrant community of North Beach in San Francisco, and the executor role brought Giannini into contact with the bank's operations. What he saw appalled him. The Columbus Savings and Loan was not serving the people it existed to serve. Its directors, successful businessmen who regarded the bank primarily as a commercial convenience for their own business relationships, were making loans to each other and to their commercial acquaintances, while declining to lend to the ordinary Italian immigrants of North Beach, who needed credit to start businesses, buy homes, and build the economic foundations of their lives in a new country. The bank was, in Giannini's assessment, a private club for the already prosperous operating under the false pretense of being a community institution. He tried to change this from within, joining the board and pushing for a more expansive lending policy. He was consistently outvoted by the existing directors, who regarded his proposals as recklessly generous. In 1904, frustrated by his inability to change the institution from within, Giannini resigned from the Columbus Savings and Loan Board and announced that he was going to start his own bank. The Bank of Italy opened for business on October 17, 1904, in a converted saloon at 1 Montgomery Street in San Francisco's North Beach neighborhood. The neighborhood was the heart of San Francisco's Italian immigrant community, the home of fishermen, produce vendors, restaurant workers, laborers, and small business owners who had come from Italy and Sicily in the waves of late 19th and early 20th century immigration that were transforming California's demographics. Giannini's founding capital was $150,000, raised from 18 investors who were mostly small businessmen and community leaders from the North Beach Italian community. Giannini himself contributed $3,000. His personal contribution deliberately kept small, he explained to his investors, because he did not want his personal financial interest in the bank to create any conflict with his obligation to serve its customers. The bank's profits, he announced from the beginning, would be distributed widely among many shareholders, rather than accumulated in the hands of a few large investors. This was not merely a financial arrangement, it was a statement of philosophy. The specific philosophy that Giannini brought to banking was genuinely revolutionary, and it is worth understanding in detail because it was the foundation of everything he built. American banking in 1904 was, in the overwhelming majority of its practice, a service for the prosperous. Banks held the deposits of people who already had money and made loans to businesses and individuals that already had assets adequate to serve as collateral. The ordinary working person, the immigrant laborer, the small farmer, the woman running a boarding house, interacted with the banking system primarily as a depositor in the good times and a supplicant in the bad. Credit, which was the primary tool through which economic mobility was possible, was effectively inaccessible to anyone without existing wealth. Giannini rejected this model completely. His bank was explicitly founded on the premise that ordinary working people, people of modest means, people without existing collateral, people whom the established banks of San Francisco had no interest in serving, deserved access to banking services on fair and respectful terms. He was not offering charity, he was offering banking. The distinction mattered to him enormously. Charity implied that the recipients were objects of benevolence, while banking implied that they were customers deserving the same quality of service as any other customer. The specific innovations that distinguished the Bank of Italy from its competitors in 1904 were not primarily financial innovations in the technical sense. They were innovations in the culture and the practice of banking, changes to who the bank served, how it served them, and what it expected from them in return. The Bank of Italy solicited small deposits, amounts as small as $1, at a time when the established banks of San Francisco generally regarded small depositors as more trouble than they were worth. It made small loans for home improvements, for the purchase of equipment, for the working capital needs of small businesses, at a time when most banks reserved their lending capacity for larger transactions where the economics were more favorable. The bank's loan officers were instructed to assess creditworthiness not primarily through the evaluation of collateral, but through the evaluation of character, through the assessment of whether the loan applicant was hardworking, reliable, and genuinely committed to repaying the loan. This was not naive sentimentality. Giannini understood, from his years in the produce business, that the most reliable predictor of repayment was not the size of someone's existing assets, but the strength of their work ethic and their personal integrity. A hardworking person with modest assets would repay a loan. A wealthy person of questionable character might not. The bank also operated in ways that were physically designed to be accessible and welcoming to people who had no previous experience with banks and who found the formal atmosphere of the established institutions intimidating. Giannini was personally present on the banking floor in the early years, greeting customers, explaining the bank's services, and demonstrating through his own behavior that the Bank of Italy was a place where ordinary people were genuinely welcome. He spoke Italian as well as English. He understood the specific concerns and the specific economic circumstances of the immigrant community he was serving. He was not a banker looking down at his customers from behind the barrier of a formal institution. He was a community member who happened to be running a bank. The results were rapid and substantial. Within months of opening, the Bank of Italy had attracted more deposits than any of the more established institutions serving the North Beach community. The word spread through the Italian immigrant community that this was a bank that actually lent money to ordinary people, that if you went to the Bank of Italy and you needed credit to start a small business, or repair your home, or get through a difficult period, you would be treated with respect, and your application would be seriously considered. This reputation drew customers not just from North Beach, but from the Italian immigrant communities of other San Francisco neighborhoods. And within the first year of operation, the Bank of Italy had deposits that exceeded all of Giannini's most optimistic projections. By the time the earthquake struck in April 1906, the Bank of Italy was 2 years old and firmly established as the primary banking institution for San Francisco's Italian immigrant community. Its assets were modest by the standards of the city's established banks. It was a small institution serving a specific community, but the specific community it was serving was one that was grateful for its existence in a way that created a loyalty that would prove to be the foundation of everything that followed. The morning of April 18th, 1906 was, for Amadeo Giannini, a moment that compressed into a single day everything he believed about banking and about his responsibility to the people his bank served. He had been asleep at his home in San Mateo, about 20 miles south of San Francisco, when the earthquake struck. The shaking was severe enough to wake him and send him outside. He looked north and saw the orange glow of fires beginning over San Francisco. He understood immediately that the city was in catastrophe, and his first thought, by his own account told many times over the subsequent decades, was not for his own property or his own safety, but for the bank's deposits, which were held in a vault in the North Beach building. He made his way into the city on a horse-drawn produce wagon he borrowed from his brother-in-law. The streets were chaotic, buildings collapsed, gas lines burning, water flowing from broken mains across the pavement, people moving through the smoke in various states of shock and urgency. He reached the Bank of Italy building and found it structurally intact. The earthquake had not destroyed it, but the fires were spreading, and it was clear to him that the building would not survive the day. He retrieved the bank's cash, gold coins and securities from the vault, approximately $80,000 in total, and loaded them onto the wagon. To conceal the nature of the cargo from the looters who were already moving through the disaster zone, he covered the money with a layer of vegetables from a nearby produce stand. Then he drove the wagon through the burning streets to the wharf at North Beach, where his brother-in-law's boat took the cargo to San Mateo for safekeeping. The established banks of San Francisco in the days that followed responded to the disaster by closing their doors and waiting. Their vaults, many of which were made of brick, had been damaged by the fires to the point where the metal components of the vault doors had fused, making it impossible to open them safely until they had cooled down completely. The San Francisco Clearinghouse Association announced that no banks would be permitted to open until the vaults had been inspected and declared safe, and that the process was expected to take at least 10 days. 10 days, in the immediate aftermath of a disaster of this scale, was an eternity. The people of San Francisco needed money to buy food, to pay for temporary shelter, to begin the process of clearing their properties and planning the reconstruction of their homes and businesses. They had money in the banks, savings they had accumulated over years of work, but they could not access it. The banking system, in the moment when the people needed it most, had retreated behind its vault doors. Giannini did not wait. He could not open his permanent premises. The North Beach building was in a neighborhood still recovering from fire damage. But he did not need permanent premises. Within days of the earthquake, he had set up a temporary banking operation on the Washington Street wharf, 2 wooden planks across 2 barrels, with a sign identifying it as the Bank of Italy. It was the most stripped-down banking operation imaginable, and it was, in the specific moment of San Francisco's greatest need, exactly what the city required. The loans that Giannini made from the plank across barrels office in the days immediately following the earthquake were made without formal application procedures, without collateral requirements, without the bureaucratic apparatus that banking normally required. He looked at the people who came to him. He asked them their names, their occupations, their circumstances. He assessed their character in the direct, practical way that his years in the produce business had taught him, looking at their hands, listening to how they spoke, observing the way they carried themselves. And he lent them money, modest amounts, to ordinary people at fair interest rates on the basis of his personal judgment that they were trustworthy and hardworking. The loans were repaid, not all of them immediately, and not all of them in full. But the overwhelming majority of the earthquake reconstruction loans that Giannini made from his plank and barrels office were repaid, demonstrating in the most concrete possible terms that his theory of character-based lending was not merely sentimental but commercially sound. People who had been treated with respect and trust by their banker in the moment of maximum need did not forget it. They repaid their loans because they believed the bank had believed in them, and they could not let that belief go unrewarded. The earthquake and its aftermath were the event that transformed Giannini from a successful community banker into a figure of wider significance. The contrast between his response to the disaster and the response of the established banks was so stark, and the practical benefit of his approach was so visible that it attracted attention well beyond the Italian immigrant community that had been the Bank of Italy's original focus. Other communities, other individuals, other institutions began to notice what the Bank of Italy had done, and what it suggested about what banking could be if it was organized around a different set of priorities. The Bank of Italy emerged from the earthquake crisis with more deposits, more customers, and more community trust than it had before. The established banks that had closed their doors had, in Giannini's view, betrayed their essential purpose. They had demonstrated that when the choice was between protecting their own assets and serving their customers, they would choose their assets. The Bank of Italy had demonstrated the opposite, and the community remembered. The reconstruction of San Francisco provided Giannini with the commercial platform he needed to begin the next phase of his ambition. He had proven that his approach to banking worked in the most demanding possible test. He had proven that ordinary working people would repay loans made on the basis of character rather than collateral. And he had established the Bank of Italy's reputation in a way that no advertising campaign could have achieved, through direct, visible action at the moment when action mattered most. He was 36 years old. He had been in banking for less than 2 years, and he was just beginning. The single most consequential financial innovation that Amadeo Giannini introduced to American banking was not a product, not a lending technique. not a technology. It was a structure. The branch banking system that transformed American retail banking from a collection of independent local institutions into a network of connected offices capable of serving customers across vast geographic areas. Branch banking, the operation of a single bank through multiple offices in different locations, existed in various forms in Europe and in some American states before Giannini began his expansion, but it was not the dominant model of American commercial banking. The dominant model was unit banking, a single bank with a single office, serving the immediate community in which it was located. The unit banking model had deep roots in American political culture and in the specific suspicion of concentrated financial power that had shaped American banking regulations since the Jacksonian era. Multiple branches meant larger banks, and larger banks meant the kind of concentrated financial power that American populism had always regarded as a threat to democratic self-governance. Giannini's argument for branch banking was not primarily about efficiency or profit, though it had implications for both. It was about service. A single branch bank in North Beach could serve the Italian immigrant community of North Beach, but a network of branches across San Francisco could serve the immigrant communities of every neighborhood: the Irish of the Mission, the Chinese of Chinatown, the workers of the waterfront, the small farmers of the outskirts. And a network of branches across California could serve the agricultural communities of the Central Valley, the fishermen of Monterey, the vineyard workers of Napa and Sonoma. The geographic reach of branch banking was, in Giannini's vision, directly connected to the democratizing mission that had motivated the Bank of Italy from its founding. The ordinary working person needed banking services wherever they lived and worked, not just in the neighborhoods that happened to have a bank. The farmer in Fresno deserved the same access to credit as the merchant in San Francisco. The vineyard worker in Napa deserved the same access to a savings account as the shopkeeper in Los Angeles. Branch banking was the mechanism through which the banking system could be made genuinely national and genuinely democratic. The expansion began cautiously. In 1907, Giannini opened the Bank of Italy's first branch in the San Jose neighborhood of the city, his birthplace and a community with a significant Italian immigrant population. The branch was modestly staffed and modestly capitalized, but it demonstrated the essential soundness of the concept. A branch bank could serve a new community using the organizational infrastructure of the parent institution, reducing the fixed costs of establishing banking services in a new location and making it economically viable to serve communities that would not have been large enough to support an independent bank. The expansion accelerated rapidly after the success of the San Jose branch. By 1909, the Bank of Italy had opened branches in several San Francisco neighborhoods. By 1913, it had expanded outside San Francisco to other Northern California communities. By 1918, it had branches in Los Angeles and was beginning the expansion into Southern California that would eventually make it the dominant bank in the state. The expansion was not unopposed. The unit bankers of California, the owners and managers of the independent local banks that Giannini's branch network was threatening to displace, were fierce opponents of branch banking, and they had powerful allies in the California state legislature and in the federal banking regulatory system. The arguments against branch banking were partly economic, that large branch banks would use their scale advantages to drive smaller competitors out of business, and partly political, that concentrated banking power was dangerous to democratic governance. Giannini engaged with both arguments directly and persistently. His economic response was that branch banking actually increased competition by bringing banking services to communities that had not previously had them, that the establishment of a Bank of Italy branch in a small agricultural town created banking competition in a community that had previously had none, rather than reducing the competition that had existed. His political response was more complex. He acknowledged the concern about concentrated financial power, but argued that the concentration that concerned democratic reformers was the concentration of banking power in the hands of a small number of wealthy individuals and institutions, not the geographic consolidation of banking services under a single organizational roof. His bank, he argued, was not a concentration of power in the hands of a few, but a distribution of services to the many. The agricultural banking that the California branch network made possible was one of the most practically significant dimensions of Giannini's contribution to the state's development. California agriculture in the first decades of the 20th century was undergoing a transformation from subsistence farming and small-scale production to the large-scale commercial agriculture that would eventually make the state the most productive agricultural region in the United States. This transformation required capital for irrigation systems, for specialized equipment, for the purchase of land, and the financing of the crop cycles that agricultural production required. The small farmer, the immigrant family farming 20 acres in the Central Valley, the Italian or Portuguese or Japanese farmer growing grapes or vegetables or citrus needed access to short-term credit for seeds and equipment and longer-term credit for land and irrigation development. The established banks had limited interest in agricultural lending of this kind. The amounts were small. The borrowers were often recent immigrants with limited English and limited collateral, and the specific risks of agricultural lending were not well understood by bankers whose experience was primarily commercial and urban. The Bank of Italy developed the agricultural lending expertise that the California farming community needed, hiring loan officers who understood farming and who could assess agricultural credit risk in the specific practical terms that agricultural borrowers required. The bank lent to small farmers across the Central Valley, the wine country, and the coastal agricultural regions, financing the production of crops that would eventually feed the nation. The loans were repaid at rates that demonstrated, again, that Giannini's character-based lending philosophy was not naive sentimentality, but sound commercial practice. By the early 1920s, Amadeo Giannini had built the Bank of Italy into the largest bank in California. The branch network extended across the state, from Eureka in the north to San Diego in the south, with particular strength in the agricultural communities of the Central Valley and the growing urban markets of Los Angeles and San Francisco. It was an extraordinary achievement for a man who had entered banking less than 2 decades earlier with a converted saloon and $150,000 in founding capital. But Giannini was not interested in having built the largest bank in California. He was interested in building the largest bank in the United States, and ultimately in proving that banking could be organized on a genuinely national scale, serving ordinary Americans from coast to coast in the way that the branch network had demonstrated it could serve ordinary Californians from the Oregon border to the Mexican frontier. The path to national banking ran through New York, which was the center of the American financial system and the city where the political and regulatory battles over branch banking would ultimately be decided. But before turning to New York, Giannini built one of the most unlikely and most consequential banking relationships in the history of American finance: his relationship with the Hollywood film industry. The motion picture industry of the early 1920s was, from the perspective of the established banking system, a poor risk. The studios, the nascent companies that were beginning to produce the feature films that would eventually define American popular culture for a century, were young, financially precarious, and operating in an industry whose economics were poorly understood by bankers, whose experience was primarily with manufacturing, commerce, and agriculture. The collateral that a film studio could offer was intangible. The future earnings of films that had not yet been made from scripts that might or might not attract audiences, and the established banks of both Los Angeles and New York were largely unwilling to extend credit on these terms. Giannini saw it differently. He had spent 20 years lending money to people and businesses that the established banking system had dismissed as poor risks, and he had developed both the analytical framework and the practical experience to assess credit risk in unconventional contexts. When the film studios of Hollywood came to him seeking credit, he looked at the business with the same direct, practical intelligence he had applied to the Italian fishermen of North Beach and the almond farmers of the San Joaquin Valley. What he saw was a young industry with enormous commercial potential, managed by creative and entrepreneurial individuals who had demonstrated their ability to attract audiences and generate revenues, but who were chronically undercapitalized because the established banking system had refused to lend them the money they needed to produce their films at the scale that the growing audience demanded. The risk was real. Films were a speculative commercial proposition in ways that a grocery store or a citrus orchard was not. But the potential return was equally real, and the character and capability of the people running the studios was, in Giannini's assessment, adequate to make the risk manageable. The Bank of Italy, which had by this point been reorganized and rebranded as the Bank of America of California, became the primary lender to the Hollywood film industry. Among the studios it financed were the early iterations of what would become major industry players. It lent to Charlie Chaplin to finance his independent productions, to United Artists when the studio was being established by Chaplin, Pickford, Fairbanks, and Griffith, to the studios that were producing the westerns and comedies and melodramas that were filling the nation's movie houses in the boom years of the 1920s silent film era. The Hollywood lending was profitable, demonstrating again that Giannini's willingness to lend where others refused was not merely altruistic but commercially sound. The studios repaid their loans. The films generated the revenues that the loan analysis had projected, and the Bank of America's position as the banking partner of the film industry gave it relationships that would prove enduringly valuable as Hollywood became one of the most commercially significant industries in American life. The home mortgage was another dimension of Giannini's commercial innovation that had profound social implications. Home ownership, the aspiration of virtually every American family of modest means, was, in the early decades of the 20th century, genuinely difficult to achieve because the mortgage instruments available were poorly suited to the financial circumstances of ordinary families. The balloon mortgage, which was the dominant form of home financing in the early 20th century, required the borrower to make regular interest payments for a term of 5 to 7 years, and then to repay the entire principal in a single lump sum at the end of the term. For a family of modest income, the balloon payment was almost impossible to meet from savings, which meant that home ownership required either substantial inherited wealth or access to a refinancing market that was not always available. Giannini championed the long-term amortizing mortgage, the structure in which the borrower makes equal monthly payments of principal and interest over a period of 20 to 30 years, gradually building equity in the property until the mortgage is fully paid off. This structure, which seems obvious in retrospect, was genuinely innovative in the context of the American mortgage market of the early 20th century. It made home ownership financially accessible to families whose monthly incomes were adequate to service a long-term loan, even though their accumulated savings were insufficient to meet a balloon payment. The democratization of home ownership that the long-term amortizing mortgage enabled was one of the most significant social achievements of 20th century American capitalism. And Giannini's role in promoting and popularizing this financing structure was a direct contribution to it. The millions of American families who bought their first homes in the 1920s, 1930s, and 1940s using the kind of mortgage that the Bank of America had helped develop and popularize were the direct beneficiaries of a financial innovation whose democratic implications Giannini had understood and pursued from the beginning. The expansion of Amadeo Giannini's banking operations in the 1920s brought him into direct conflict with the most powerful force in American banking, the New York financial establishment, which regarded the California banker's national ambitions with a mixture of contempt, alarm, and the specific hostility of entrenched power towards someone who was threatening its position. The New York banking establishment of the 1920s, led by J.P. Morgan and Company, the major New York commercial banks, and the network of investment banks that controlled the capital markets of the United States, was not a formal conspiracy. It was something more powerful and more durable than a conspiracy. A set of shared interests, shared assumptions, and shared social relationships that had developed over generations, and that gave the major New York financial institutions a structural dominance over American banking that was deeply resistant to challenge. Giannini's specific challenge to this dominance was not merely commercial. He was not simply competing for deposits and loans with the New York banks. He was advancing a fundamentally different vision of what banking was for, a vision in which ordinary people were the primary customers rather than large corporations and wealthy individuals, in which banking services were distributed geographically to serve all Americans rather than concentrated in the financial centers of the northeastern states, and in which the banking system as a whole served the broad population rather than the narrow interests of the established financial elite. This was, in the specific political context of the 1920s, a genuinely radical proposition. The progressive era had produced significant regulatory responses to the concentration of financial power, the Federal Reserve System, established in 1913, and the various state banking regulations that constrained the activities of commercial banks. But the fundamental structure of the American banking system, with its unit banking model and its domination by the major New York institutions, remained largely intact. Giannini's challenge to this structure was seen by those who benefited from it as exactly the kind of threat to established interests that the regulation of banking was supposed to prevent. The specific battles that Giannini fought with the New York financial establishment in the 1920s were both regulatory and commercial. On the regulatory front, the Federal Reserve System's Board of Governors became the primary arena in which the battle over branch banking was contested. The Federal Reserve had the authority to approve or deny applications for new branches, and the use of this authority became, in the hands of regulators who were sympathetic to the unit banking lobby, a mechanism for constraining Giannini's expansion. The most significant of these regulatory battles was the attempt in 1919 and the early 1920s to establish a genuinely national banking presence by acquiring banks in other states. California state law permitted statewide branch banking, and the Bank of Italy had exploited this permission to build its California network. But federal law severely restricted interstate banking, the ability of a bank chartered in one state to operate branches in another, in ways that made it effectively impossible to build the kind of national branch banking network that Giannini envisioned. Giannini's response to the interstate banking restriction was characteristically innovative. He organized Banca Italia Corporation, a holding company that owned shares in multiple separately chartered banks in different states. The holding company structure was, in his argument, distinct from a branch banking operation. The individual banks remained separately chartered and separately regulated, while the holding company provided the organizational coordination and the capital efficiency that made the network commercially viable. The Federal Reserve, which regarded Banca Italia with considerable suspicion, eventually required Giannini to restructure the holding company in ways that limited its scope. But the basic holding company model survived and became the template for the multi-state banking structures that would eventually dominate American commercial banking. The personal conflict between Giannini and Elisha Walker, the New York investment banker who engineered a takeover of Transamerica Corporation, the holding company that controlled Bank of America, during the period when Giannini had temporarily stepped back from the management of his institutions, was one of the most dramatic episodes in the history of American banking. Walker, representing the New York financial establishment's interests, attempted to dismantle the branch banking network, reduce the emphasis on small depositors and small borrowers, and transform the Bank of America into a more conventional institution focused on large corporate clients. Giannini, who had retired to Europe for health reasons in 1928 and who had believed he was leaving his institutions in capable hands, returned to California in 1932 when he learned the scope of Walker's intentions. What followed was a shareholder proxy battle. Giannini, who owned less than 5% of Transamerica's shares, versus Walker and the institutional shareholders of the New York financial establishment. Giannini mounted a grassroots campaign among the small shareholders of Transamerica, the ordinary Californians who had bought shares in his institutions over the years, that was unprecedented in the history of American corporate governance. He traveled across California speaking to small shareholders at community meetings, explaining what Walker intended and what the consequences would be for the ordinary depositors and borrowers who depended on the Bank of America. He framed the proxy battle as a fight between the little fellow and Wall Street, between the interests of ordinary Californians and the interests of the New York financial establishment that had always regarded the Bank of America with hostility. The framing was not merely rhetorical, it was an accurate characterization of the specific conflict being contested. Giannini won the proxy battle, recapturing control of Transamerica and the Bank of America in 1932 and dismissing Walker and his management team. The victory was a decisive demonstration of the loyalty that his decades of service to ordinary depositors and borrowers had generated, a loyalty that translated directly into the shareholder votes that determined the outcome of the proxy contest. The little fellow had voted for him, and the little fellow had won. The 1930s were, for the Bank of America and for Amadeo Giannini personally, a decade of contrasts. The Great Depression's devastating effects on the California economy on one hand, and the extraordinary construction project that became the most visible symbol of California's determination to build its future on the other. The Great Depression hit California with particular severity in certain sectors. The agricultural economy, which the Bank of America had done more than any other institution to finance and develop, was devastated by the combination of drought, falling commodity prices, and the collapse of the credit markets that agricultural production depended on. The Dust Bowl migration, the hundreds of thousands of dispossessed farmers from Oklahoma, Arkansas, and other devastated agricultural states who poured into California seeking work, created enormous social pressure on a state already struggling with mass unemployment and collapsing farm income. Giannini's response to the Depression was characteristic. While many banks were contracting their operations, calling in loans, and reducing their exposure to the stricken agricultural economy, the Bank of America continued to lend, cautiously, with more rigorous credit assessment than the boom years of the 1920s had required, but consistently committed to the proposition that the bank's role in a crisis was not to retreat, but to provide the financial support that would enable its customers to survive and eventually recover. The bank did not emerge from the Depression unscathed. Loan losses were significant. The bank's earnings were severely reduced. There were moments when the institution's ability to continue operating was genuinely uncertain, and the regulatory environment of the early Depression years, with bank failures occurring at catastrophic rates across the country, created pressures that tested the Bank of America's financial resilience as severely as the earthquake of 1906 had tested its institutional character. The bank survived. It survived in part because of the geographic diversity of its California branch network, with operations across multiple economic sectors and multiple regions of the state. The losses in the most severely affected areas were offset by the relative stability of others. It survived in part because of the loyalty of its depositor base. The small savers who trusted the Bank of America because Giannini had spent 30 years earning that trust were less likely to engage in the bank runs that destroyed less community-embedded institutions. And it survived in part because of the specific relationships that Giannini had built with the Roosevelt administration, which was attempting to stabilize the American banking system through the New Deal programs that were being designed and implemented in the first years of the Democratic presidency. Giannini's relationship with Franklin Roosevelt was not uncomplicated. Giannini was supportive of the New Deal's general direction, particularly its emphasis on providing relief to ordinary Americans and on reforming the banking system in ways that reduced the power of the large New York banks. But he was also at various points in conflict with specific New Deal regulatory initiatives that he believed were poorly designed or that he believed were being used by his enemies in the regulatory system to constrain his operations in ways that served narrow institutional interests rather than the public good. The financing of the Golden Gate Bridge was one of the most memorable and most consequential acts of Giannini's career in the 1930s. The project, the construction of the suspension bridge across the Golden Gate Strait that would connect San Francisco to Marin County, had been planned since the 1920s, but had repeatedly stalled for lack of financing. The Depression had made conventional municipal bond financing essentially impossible. The capital markets were in disarray, and investor appetite for the bonds of a California governmental authority was limited. Giannini provided the financing. In 1932, at a moment when the Depression was at its most severe, and when most financial institutions were reducing their exposure to any investment of uncertain outcome, the Bank of America purchased $6 million in Golden Gate Bridge bonds, a commitment that made the project financially viable at a moment when it had no other credible source of funding. The decision was made by Giannini personally, against the advice of some of his senior bankers, who questioned the credit risk of a bond secured by toll revenues from a bridge that had not yet been built. Giannini's argument for the investment was partly financial. He believed the bridge would be built and the tolls would be paid, and partly the same philosophy that had motivated every major decision of his banking career, the belief that California's development was a cause worth backing with the bank's resources, and that the Bank of America's role in that development was not merely commercial, but genuinely consequential for the state and its people. The Golden Gate Bridge was built. The bonds were repaid. The bridge opened in May 1937 and became within decades one of the most recognized structures in the world, a symbol of California's ambition and achievement that owed its existence, in significant part, to a banker who was willing to commit $6 million when no one else would. The decade also saw Giannini's involvement in the financing of Walt Disney's Snow White and the Seven Dwarfs, the first full-length animated feature film in history, which Disney was producing at enormous expense and with considerable skepticism from the rest of the film industry, which regarded the project as commercial madness. The Bank of America provided the production financing that allowed Disney to complete the film, which opened in December 1937 and became one of the most commercially successful films in the history of Hollywood. These investments, the Golden Gate Bridge, Snow White, the continuing support for California agriculture through the Depression, were not merely profitable. They were expressions of a consistent philosophy about the relationship between banking and the communities that banks served. A bank that withdrew its support from its communities in times of difficulty, that protected its own assets at the expense of the people who needed credit to survive and rebuild, was not, in Giannini's view, serving its proper function. A bank that continued to provide financial support when others had retreated was demonstrating, in the most concrete possible terms, the specific vision of banking that had motivated him since he watched the established banks close their doors after the 1906 earthquake. By the late 1940s, Amadeo Giannini had built Bank of America into the largest bank in the United States, the first bank in American history to surpass $1 billion in deposits, a milestone it had reached in the early 1930s. And by the end of the Second World War, the most powerful commercial banking institution in the country and one of the largest in the world. The fortune that this achievement had generated was, by the standards of American banking, almost incomprehensibly large. The Bank of America's market capitalization, the value of the Transamerica Corporation shares, the accumulated value of the various real estate and investment holdings that the bank's operations had generated over 40 years. The sum total of what Giannini had built represented in 1945 a fortune that most people assumed to be in the hundreds of millions of dollars. Amadeo Giannini's personal net worth at the time of his death in 1949 was approximately $500,000. This fact, so startling in the context of what he had built that it requires a moment to absorb, is the most extraordinary single detail of Giannini's personal story, and it is worth understanding why it was true and what it reveals about the man. Giannini had, throughout his career, consistently refused to accumulate personal wealth from the business he was building. This was not false modesty or strategic positioning. It was a genuine personal conviction, rooted in the philosophy about money and its proper uses that had been formed in his youth watching his father be killed over wages, in his years in the produce business, when he had voluntarily reduced his own profits because he felt he was accumulating more than was fair, and in his founding of the Bank of Italy on the explicit premise that banking should serve the many rather than enrich the few. When the Bank of Italy made profits, Giannini took the salary that was appropriate to his role, a salary that was comfortable but not extravagant by the standards of the industry. He did not take the bonuses, the stock awards, and the various mechanisms of executive compensation that were standard practice among bankers of comparable institutional stature. He did not use his position to generate personal investment opportunities that his banking knowledge gave him access to, even when those opportunities were entirely legal and widely practiced by his peers. And when he discovered, in 1927, that the various arrangements he had made over the years had resulted in his accumulating a personal fortune of several $1,000,000, significantly more than he had intended or wanted, he gave it away. The mechanism of the giving was the establishment of the Bank of America Giannini Foundation, which he funded with the $1.5 million of personal wealth that exceeded what he considered appropriate and which he directed toward research in medicine and public health. The foundation was not named after him initially. He did not want his name attached to the philanthropy, and it was only at the insistence of friends and colleagues that his name was eventually incorporated. He was, genuinely, uncomfortable with the idea of personal credit for charitable giving. The philosophy that motivated this behavior was articulated by Giannini in various forms throughout his career, and it was consistent enough across decades to make clear that it was not rhetorical but genuinely held. He believed that the accumulation of great personal wealth by a person in his position was a form of betrayal, a betrayal of the depositors and borrowers whose trust and whose resources had made the institution possible, and a betrayal of the democratic vision of banking that had motivated the founding of the Bank of Italy in 1904. A banker who built a great institution and then enriched himself from it was, in Giannini's view, doing exactly what the directors of the Columbus Savings and Loan had been doing when he joined their board in 1902, and found them using the community institution for personal enrichment. The Bank of America existed to serve its customers and its communities, not to make its chairman wealthy. If the chairman became wealthy as a byproduct of the institution's success, the appropriate response was to give the excess wealth away, to redirect it toward purposes that served the public rather than personal interest. This philosophy expressed itself not just in his personal financial choices, but in his approach to the bank's governance and its culture. He was famously hostile to the formation of a banking aristocracy, to the development within the Bank of America of an executive class whose compensation and whose sense of entitlement separated them from the customers the bank existed to serve. He believed that the bank's executives should live modestly, should understand the financial circumstances of the ordinary depositors and borrowers who were the bank's primary customers, and should feel a genuine sense of personal obligation to those customers rather than the detached professionalism of managers serving a corporate interest. The man who had built the largest bank in the United States died on May 3, 1949, at his home in San Mateo, of congestive heart failure. He was 79 years old. His estate was valued at approximately $500,000, less than the personal wealth of many middle-ranking officers of the bank he had founded and led for 4 decades. He had, quite deliberately and quite consistently, given away or forgone the fortune that his achievement would have generated if he had approached it with the motivation of personal enrichment rather than the motivation of service. The obituaries noted the paradox. The man who had built the largest bank in the world had died almost poor by the standards of his own industry. The observation was accurate and appropriate. It captured something essential about who Giannini was and what he had been trying to demonstrate throughout his career, that banking could be organized around service rather than personal enrichment, that the largest bank in the world could be built by someone who was not in it for the money. Whether the institution he left behind maintained his philosophy is a question that the subsequent history of Bank of America answers with less clarity than Giannini's own record provides. The bank grew larger after his death. It became, in the 1950s and 1960s and 1970s, the prototype of the mass-market commercial bank that served tens of millions of ordinary Americans. It invented the credit card, the Bank AmeriCard, introduced in 1958, which became Visa, and which transformed American consumer finance in ways that had both the democratizing implications that Giannini would have valued and the debt-creating implications that he might have found more troubling. Amadeo Giannini's legacy is embedded so deeply in the structure of American financial life that it is almost invisible, like the foundation of a building that you walk through every day without noticing, because it does the essential work of support without demanding attention. Consider what American banking looked like before Giannini and what it looks like now. Before Giannini, banking in the United States was primarily a service for the prosperous, an institution that held the deposits of people who already had money and lent to businesses and individuals that already had assets adequate to serve as collateral. The ordinary working person, the immigrant laborer, the small farmer, the family of modest means, interacted with the banking system primarily as a depositor and rarely as a borrower. Credit was a privilege, not a service. After Giannini, the relationship between ordinary Americans and the banking system was fundamentally different. Branch banking had brought banking services to communities across the country that had previously been unserved or underserved. The long-term amortizing mortgage had made home ownership accessible to families whose incomes were adequate to service a loan, even though their savings were insufficient to meet a balloon payment. Agricultural lending programs had made credit available to small farmers who had previously been dependent on the exploitative credit of local merchants and commission agents. And the consumer credit innovations that the Bank of America pioneered in the 1950s, including the credit card, had extended credit access to ordinary consumers in ways that had both expanded their economic possibilities and created new risks. The branch banking model that Giannini pioneered became the dominant model of American commercial banking. The unit banking system that his expansion had challenged gradually gave way as state and eventually federal regulations were relaxed to the statewide and eventually interstate branch banking that made the major American commercial banks genuinely national institutions. The banks that dominate American retail banking today, J.P. Morgan Chase, Bank of America itself, Wells Fargo, Citibank, are all institutions organized on the branch banking model that Giannini developed and defended against decades of regulatory hostility. The credit card, which the Bank of America introduced in California in 1958 under the name Bank AmeriCard, was one of the most consequential financial innovations of the 20th century, and its origins in Giannini's philosophy of extending credit to ordinary consumers are not coincidental. The Bank Americard was explicitly conceived as a tool for bringing credit access to the consumers who did not qualify for the business credit lines and charge accounts that had previously been the primary vehicles for consumer credit. It was Giannini's philosophy, credit for the little fellow, applied to the mass consumer market of post-war America. The Bank Americard was eventually licensed to banks across the United States and internationally, evolving into the Visa network that is today one of the two dominant payment networks in the world. The other dominant network, MasterCard, traces its origins to a competing consortium of banks that was formed in direct response to the Bank Americard's success. The global payment infrastructure that processes billions of transactions daily, the system that makes it possible to pay for goods and services in almost any country in the world using a single card, owes its existence in a direct and traceable line to the decision by the Bank of America in 1958 to give ordinary California consumers a piece of plastic that let them buy now and pay later. The housing finance implications of Giannini's mortgage innovations are equally profound. The 30-year fixed-rate mortgage, the instrument through which the majority of American home purchases have been financed since the 1940s, is the institutionalized version of the long-term amortizing mortgage that Giannini championed in the 1920s. The mass home ownership that this instrument made possible was one of the central achievements of 20th century American capitalism. The suburban expansion, the middle-class wealth accumulation through home equity, the social stability associated with widespread property ownership, and it was built on a financing structure that Giannini had argued for and demonstrated when the rest of the banking industry was skeptical. The agricultural banking legacy is visible in the structure of California agriculture itself. The Central Valley, the most productive agricultural region in the United States, producing a significant share of the nation's fruits, vegetables, and nuts, was developed in its modern form through the credit that the Bank of Italy and subsequently the Bank of America provided to small farmers in the first half of the 20th century. The Italian and Portuguese and Chinese and Japanese farming families who planted orchards and vineyards and vegetable farms across the valley did so with credit that the Bank of America provided when no other institution was willing to lend to them. The Bank of America itself, the specific institution that Giannini founded as the Bank of Italy in 1904, has had a complicated subsequent history that is not entirely consistent with the legacy of democratic banking that Giannini established. The bank grew enormously in the decades after Giannini's death, becoming the largest bank in the United States and eventually the largest bank in the world. It went through periods of ambitious expansion that produced both commercial success and commercial disaster. The international lending of the 1970s, which contributed to the sovereign debt crises of the early 1980s, the real estate lending of the late 1980s, which produced massive losses, and the near collapse that required fundamental restructuring, the eventual merger with Nations Bank in 1998, which created a new entity that retained the Bank of America name, but that was, in most organizational respects, a continuation of the North Carolina-based Nations Bank rather than of Giannini's California institution. The Bank of America that exists today is one of the 4 largest banks in the United States, with total assets exceeding $3 trillion and operations across the country and internationally. It serves tens of millions of consumers, businesses, and institutional clients. It is, in its scale and its geographic reach, a direct institutional descendant of the vision that Giannini articulated in 1904, a genuinely national bank serving all Americans rather than a few. Whether it maintains the specific values that Giannini tried to embed in its culture, the commitment to the little fellow, the refusal to treat ordinary customers as second-class banking citizens, the willingness to lend to people without collateral on the basis of character, is a question that the institution's actual practices, rather than its official narratives, must answer. What is not in doubt is Giannini's place in the history of American capitalism. He is one of the handful of individuals, alongside Carnegie and Rockefeller and Ford and a few others, whose specific innovations and specific decisions genuinely transformed the economic life of the nation. His specific contribution, the democratization of banking, the extension of financial services to the ordinary Americans who had been excluded from full participation in the financial system, was one of the most consequential acts of social and economic inclusion in the history of American capitalism. He did not do it for the money. He did it because he believed that banking was too important to be left to the already wealthy, and that the financial system would only serve the full range of American society if someone was willing to build the institutions that would serve the full range of American society. He built those institutions across 4 decades of effort and conflict and occasional failure, with a consistency of purpose and a clarity of values that distinguished him from virtually every other figure of comparable commercial stature in the history of American finance. The man who set up a plank across 2 barrels on the San Francisco waterfront on the morning after the earthquake. The man who lent money to people on the basis of their calloused hands and their honest eyes when the established banks were locked behind their vaults, was the same man who built the largest bank in the world and died worth $500,000. The consistency between the founding moment and the final reckoning is perhaps the most eloquent summary of what he was. He believed banking should serve the people. He spent his life proving it was possible, and the American financial system was changed permanently and fundamentally because he did. So we have traced the full arc, from the converted saloon in North Beach in 1904, through the earthquake and the plank across 2 barrels, through the branch banking revolution and the Hollywood loans and the Golden Gate Bridge financing, through the proxy battle with Wall Street and the New Deal years, to the moment when the largest bank in the world was inherited by an institution worth $500,000 to its founder. The Giannini story is, at its most fundamental level, a story about what banking can be when it is organized around the right purpose. Banking is not inherently a tool for the enrichment of the few or the exclusion of the many. It is a mechanism for the mobilization and allocation of capital, a mechanism that can be organized to serve narrow interests or broad ones, to deepen inequality or to reduce it, to exclude the powerless or to include them. The choices made by the people who build and run banking institutions determine which of these possibilities the system realizes. Giannini made specific choices across 4 decades that consistently prioritized the broad possibility over the narrow one. He chose to serve the immigrant fisherman rather than the established merchant. He chose to lend on character rather than collateral. He chose to bring banking to the small farmer rather than to restrict it to the large corporation. He chose to build a national bank rather than to protect a local monopoly. And he chose, consistently and deliberately, to not enrich himself from the institution he was building. These choices had consequences that extend far beyond the specific institution he built. They established models, they proved possibilities, and they shifted the expectations of what banking could and should be in ways that influenced every institution that followed. The branch banking model, the consumer mortgage, the credit card, the agricultural lending program, all of these innovations, all of these demonstrations that banking could serve ordinary people profitably and sustainably, changed what was considered possible and therefore changed what was eventually done. The modern relevance of the Giannini story is not primarily about banking innovation. It is about the relationship between purpose and achievement, about what happens when someone builds a large institution while maintaining across decades and against significant opposition a consistent clarity about what the institution exists to do and who it exists to serve. The clarity did not make the building easy. It made it meaningful. And the meaning in Giannini's case was expressed in the $500,000 he left behind, in the gap between what he could have taken and what he chose to leave, which was itself the most precise measure of everything he had built. From a plank across 2 barrels to the largest bank in the world, and $500,000 in the estate. That is the Giannini story. And it is in the specific way that only true stories about genuinely extraordinary people can be, both completely implausible and completely true. If this one moved you, if there was a moment in Giannini's story that made you think about what institutions are for and who they should serve, drop it in the comments. The story of someone who built the largest bank in the world and refused to keep the money is, in my experience, one of the more genuinely surprising stories in American business history. The best single source on Giannini's life is Felice Bernardio's biography, A.P. Giannini, Banker of America, which covers his career with the depth and the critical distance that a life of this significance deserves. The Bank of America's official institutional history written by Marquis James and Bessie James, is also valuable but should be read with some awareness of its institutional perspective. If you found this depth useful, subscribing is the simplest way to make sure you see the next one when it comes out. The natural follow-up to this video is our episode on Walter Wriston of Citicorp, the other great democratizer of American banking, who built the first genuinely global consumer bank in the 1970s and 1980s, and whose specific financial innovations, including the negotiable certificate of deposit and the variable rate mortgage, reshaped the American financial system in ways that were both liberating and, in the case of the variable rate mortgage, eventually catastrophic. The contrast between Giannini's philosophy and Wriston's is one of the most instructive in the history of American banking. The link is in the description. Thank you for watching something that takes the full complexity of a great builder seriously. See you in the next one.